I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, today we're going to focus on the continuing economic recovery. And while we're seeing signs of a healing economy and strong markets, we're also reading concerning headlines resulting in a decline in the Consumer Confidence Index. So I thought we'd start off today with a brief review of some of those drivers. First, for many businesses, September was planned as a month in which employees would be back to the office. So those businesses are now really rethinking and are cautious not to relax restrictions given the uptick in COVID cases and hospitalizations, including some of the concerning numbers we're seeing from children being hospitalized. To add to that point, fears of breakthrough COVID cases for those that have already been vaccinated have resulted in not only new travel restrictions, but it's also impacting consumer behavior and therefore spending. When we think about the global perspective, businesses in China are experiencing regulatory crackdowns by their government in a number of industries. And I know that's certainly a factor as we think about emerging markets. And most notably, earlier this week, the final evacuation flight from Afghanistan brought to a close the longest war in US history, but not without violence and uncertainty. So despite these risks, the market seems to be continuing to look at the long term. Can you tell us more about what you're seeing and why we're not experiencing more volatility?
Yeah, you bring up great points. And the fact is that those are significant risks. The geopolitical risks, the risks in China, the risks at home here with the COVID continuing change, the continuing change of that dynamic. The real issues, I think, revolve around, well, what's happening in the underlying economy? Where can we point to evidence of improvement? And what's the market concerned with? And we show the unemployment rate here, which is a consistent measure of, well, how is the US economy doing? How is the labor market healing? And despite some of those potential delays that you talked about, Carrie, we're still seeing a slow progression of improvement in the labor market. And while there's a consumer sentiment slowdown, the fact is that, when you look forward maybe a year from now, the market's anticipating a full employment situation, meaning more and more people back to work. The other thing that the market's looking at is the impact of rising interest rates, and maybe that's going to slow things down. The fact is that the 10-year Treasury bond yields have settled down at a relatively low level at 1.3%. And that suggests that the market's not really concerned about overheating or inflation, at least at the moment. The other thing that came out more recently was the Federal Reserve's statement. What are they going to do with their policy? And the first thing they said was they anticipate some tapering, which means they're going to stop buying the bonds for their balance sheet to support the markets. A couple of years ago, that tapering announcement caused a lot of volatility in the market. What we're seeing is that this time it's not the case, and mainly because the market's sort of anticipating that, already priced in, baked in. And the fact is that the Fed also said that they're unlikely to increase their interest rate, their policy rate, anytime soon. The market sees that as continued support. And, basically we think that global stock markets will continue to do relatively well under these current situation in the current environment. But we are seeing a little bit of a shift in leadership. That's really what's most important to us in the way we think about portfolio management. So the concerns over the COVID-19 Delta variant have in fact led to a shift back to technology and defensive sectors. And I think this is because maybe there's an expectation that the work from home policies that were sort of in place for most of last year and this year are going to be delayed delayed coming back to work. So what we're seeing is at the start of the year, there was a very strong driver of returns in the value side of the market. These are more sectors associated with an economic reopening. The gray bar and the blue line are all suggesting that there's a recovery happening, and those typically do well in that environment. What we saw was the orange line drop. That's large growth, that's technology. We can see that since March, April timeframe, the improvement has been so great that both of them are up around 20% for the year. So we talked about the market's not concerned. Well, I think it is concerned to some degree, but it's been a shift in leadership again. And we need to be thoughtful about that when we build portfolios. The other risk you highlighted was in China. And the Chinese stock market has come under significant pressure because of announcements made by the Chinese government to crack down on certain areas and sectors of the market. This has led to a significant sell-off in that sector. But I'd just like to highlight that Wescott's emerging markets managers are monitoring the situation very carefully. They are underweight Chinese markets, and they've generated significant value added this year, despite the fact that the overall market is down. I think that has a lot to do with the way that the managers think about what they're investing in, what the quality is, what the shareholder rights might be of the companies that they're holding in China specifically. So all that said, I think that the market isn't ignoring those risks, but I think there's a shift in leadership a little bit. And we're seeing that come through in the way that our managers are performing, and the portfolios are holding up nicely despite that shift in sentiment.
It's great to hear. Why don't we continue on that theme, and you can close us out today talking a little bit more about how our Wescott portfolio is positioned for the current environment.
Yeah, we started the year with expectation that we were going to come out of the COVID-19 induced recession of last year with a recovery. We still think that recovery is on track, and we're well positioned to take advantage of that recovery. And we'll talk a little bit about that in a moment. But that's despite the recent events, meaning the recent events might delay a little bit of that recovery, but it's still on track. For example, our tilt in client portfolios toward value stocks, which are trading cheaper than growth stocks, they tend to benefit when there's an economic recovery. That tilt has added a lot of value to client portfolios over the last year, and we expect that to continue as the economy reopens. The other thing I would say is that our strategic allocation to real assets like REITs and, in fact, gold, the gold exposure we have in some of the manager positions, that helps to hedge against inflation if it were to become a major risk. We just talked about how it's not a risk short term, but longer term, that's a risk that may come to fruition. And then finally, just a reminder that we build portfolios for a range of risk profiles. And on the more conservative risk profile portfolios, we have a higher allocation to defensive equity strategies. These strategies are higher quality, they have low debt on their balance sheets, and they tend to hold up better during periods of uncertainty. And by the way, they're trading on a relatively attractive valuations if you compare it to some of the other areas of the market. So all that said, we are monitoring the situation carefully. We do see the risks in the market. I think we're well positioned for that, and we're seeing evidence of how we're holding up in this environment despite some of the delays affected and the risks that you highlighted at the beginning.
Thank you, Mark. Great summary. As always, very insightful. If any of our listeners have questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. Thank you.